All right. Hey, thanks for joining me tonight, everybody. I'm going to be talking about the investment opportunity in Jacksonville, Florida. This is going to be Cabana Cove. It's 80 units in Jacksonville, Florida. And I'm going to go ahead and jump right into it. At the end, I will entertain any questions you guys might have about the investment opportunity, anything about multifamily in general. If you want to know, feel free to ask me at the Q&A at the end, because I can edit all that after the presentation. So this is Cabana Cove. John actually went out there with his wife Sonia a couple days ago, took a look at it, and it is a 70s style built property in the state of Florida. And if you guys aren't aware, Jacksonville is actually the largest city. It's actually larger than any of the two next largest cities combined as far as population goes. And also, it's the last like major growing metropolitan area in the state of Florida. Miami, obviously extremely expensive, very hard to find a deal. And as you move further north, it gets a little bit easier. So Central Florida, Orlando, Tampa, we're finding a lot of good like potential out there. You can find units anywhere between maybe 150 up to gosh, I've seen deals go up as high as $500,000 per unit. And we're talking to the scale of like hundreds of units of these properties. And so in Jacksonville, it's further north. And there's just a lot more opportunity because now that all the competition is being driven further north, it's really going to start driving the prices up in these neighborhoods, for one. And for two, as you can tell, maybe you can't, but by looking at it in the vintage, it's a 1970s property. There's a lot of like value add potential. Now, the reason why that's so important, I'm actually going to go ahead and do a little bit of education here, since there's so many first time exposure to multifamily. The difference between residential and multifamily and commercial multifamily is anything from 1 unit up to 4 units is considered residential. So even duplexes, triplexes, and quadplexes are all considered residential properties. And meaning that the bank is going to determine the value of those properties by the surrounding properties, right? Whatever the comps are. But once you get to 5 units and up, basically they look at it like a business, and the value of these properties is determined by the net operating income. Right. So the income is going to determine the value on these things. And this is why we like these older properties, because a lot of times the owners have like deferred maintenance. John saw it. There's like some roof work that needs to be done. A lot of the HVAC systems are busted. We're actually going to replace 31 of them. So we're factoring all of these things in. And the more value that you increase on the NOI, it's an exponential growth to the value of the property. I'm actually going to pull up my my calculator here, since you guys are sharing a screen. So as an example, let's just take, we use 80 as an example. There's an 80 unit property here. And let's say you just bump up the rents by, call it $30 for each unit, and you do that for the year. Big whoop, right? $28,800 an increase to the NOI, net operating income. So at surface level, that doesn't look very impressive. But again, when you take the value of that bump increase, you can divide that by the cap rate of the area. In this case, it's actually about 5, which is awesome for Florida. And you can see that just increasing the rents by that little bit that I did, how much was it that I forgot, $30, is increasing the value of this property by $576,000 when we go to reevaluate the value of this property. So keep that in mind when I go over the numbers later on, because we're definitely bumping these rents up to market level, which is significantly higher than $30. So this is a confidentiality disclaimer. This is a 506B offering. I have a pre-existing relationship with every single person on this call, which is why you guys are able to be here, even if you're a non-accredited investor. On the 506C, I would have the ability to advertise this opportunity, but you'd have to have a net worth of $1 million or more, not including your primary residence. And or you could also pass by an income qualification by either making $200,000 for the last 2 years with a reasonable expectation that that will continue into this year, or if you're married, bump that to 300,000. So there are very strict qualifications to invest into multifamily opportunities. Whenever I find a 506B, it's like a diamond in the rough, because I get to have a lot more exposure to people who normally don't get to play the game that the rich people get to play. Does that make sense, everybody? A show of hands. I see a couple people on the screen. This is the operating team. So Yvonne had asked earlier, how do I manage doing all this? I personally have a portfolio of 737 units, and there's no way I can do it by myself. I know very well Ed Modzell. He's in the same mastermind program that I am. He's actually one of the coaches and mentors in that program. And that just brings a lot of credibility and operational experience. He's been doing this for decades. Chris Freeman, I know very well. I actually had lunch with him not too long ago. And he owns his own multifamily property that he built up bootstrapping himself, one unit at a time. And he actually got rid of them all because they were all in blue states, and he was getting crushed during COVID when people not paying. So there's a lot of things, not trying to get into politics here or anything like that. But there's definitely a lot of benefits and pros and cons depending on where you're located with these multifamily properties. Personally, I like to invest in red states that are more landlord friendly, because these properties are not the easiest things to manage and run. And the last thing that you need is, the political leadership telling your tenants that they don't have to pay when, we're all beholden to the banks and everything like that as well. So this is a little bit of the market analysis. And then again, since you guys are more newer, about me real quick, if you guys don't know, I am more analytical. I'm a numbers guy. All this other stuff about presentations and market and everything like that, I get it. Florida's hot. Jacksonville is a booming market. Show me the numbers. That's what matters to me. But for you guys' benefit, a lot of you guys, this might be your first time seeing a presentation like this, so I'm going to go ahead and go into all the details. Florida, it has tons and tons of beach landscape. If you guys don't know, it's a peninsula, East Coast, down south, the Keys, and then the Gulf Coast as well. Top state for gross domestic products, awesome for business. A lot of headquarters are out in this area. We've got very favorable tax benefits, being one of the few states with no income taxes, and it's the fastest growing state in the USA. I even remember when I was in elementary school, decades ago, they were saying that 800 people per day were moving into Florida. And this whole work from home shift has actually accelerated that to the tune of like thousands of people are moving in, which is, part of the reason why property values are going up and rents are going up, which is really important for multifamily. People are leaving states like New York and California, where their cost of living is so high, and they're like, wow, I can afford a mansion out here, and it's nothing to them. Top 5 state overall in the US for well-being. Everybody wants to retire in Florida, get out of the snow, get away from that stuff. And top 5 state for manufacturing jobs. Top 3 for tech. Miami is actually going to be one of the next biggest tech hubs for the crypto space and everything like that. It's crazy seeing how it's being down here, how that's changing. And top 3 for venture capital investments and R&D funding as well. So why Jacksonville? Again, I touched on it. It's the largest city in the land and in population area. I mean, there's going to be a lot more new developments going out there because there's just the land available for that. For the top 500 Fortune 500 companies are out here. There's a lot of military. There's good access to local colleges out there, and they've got a number of sports teams as well. Also, the Duval County public school system, I will say it's not the best. Obviously, cities like Miami have really top rated education places. I mean, as far as college goes, Gainesville is home to the Gators, and Tallahassee has FSU, which are 2 of the top schools in the country, in the state. Pretty top in the country as well as far as public universities go. All these other people have their lots of employees, right? So you want a city, whenever you're looking for multifamily investments, not just for the numbers to work, but for the demographics to work as well. You want not just a high population, but a high population of working age and working people, low unemployment is very important. So this is a sky view of the property. It's 10 buildings on this one. We're going to buy this for $8.6 million, built in 1974, and currently is sporting 90% occupancy, which is awesome. 90% occupancy
Put that down.
is really important because you don't, if you don't have your occupancy high enough, lenders will not give you favorable financing. So once you get to closing, that 90% is huge to be able to make sure you're getting a very good interest rate on there. Right now, the market rates are projected to hold steady through 2025. That's great, but for me, from an underwriting perspective, and underwriting is simply just the analysis of these types of deals, right? When I run my numbers on them, I always project an increase in cap rate for every year that I hold, which essentially is saying that I'm going to get less value over time. And that's just one of the ways that I like to be conservative whenever I run my numbers, because I like to underpromise and overdeliver. If all of this stuff holds true, boom, I'm going to look like a great hero. But if, you know, if stuff hits the fan and some things go wrong because we don't have a crystal ball, we can't really predict what the future holds, I'm at least making sure that I'm factoring in for that little bit of margin, just to have a little bit of a buffer and make sure that I can still hit my investment projections, right? Renovations have already begun on this property, very close to the highway system. And again, 5.2 population growth from 2021 to 2026 is estimated, but it's probably going to be higher than that because people are being priced out of Central and South Florida. So Jacksonville is going to be one of the nicest places that they can go for a large city and have access to a lot of like waterfront, which is what people really love in the state of Florida. And remember when I talked earlier about how that $30 rent growth was going to equate to a $500,000 increased valuation, we're projecting over $200 for each unit type on average. And I'll pull that up to show what that looks like. So $200 times 80 times 12 for the year. 200 times, oh gosh, 200 times 80 times 12, and then divide that by an area cap rate of 5 is an increased valuation of to $3.8 million above what we're already getting it at. And I believe that our appraisal came in higher than our purchase price of 8.6. So all those things that I talked about considering with the projected rents, making sure our cap rates are going to be increasing the longer we hold it. We're coming out at around a 16 to 18% average annual return, right? One of the biggest reasons why I love investing in multifamily is because I don't know where else you can get risk-adjusted returns that give you 18% very predictably over the course of a number of years with this much liquidity involved. Yes, you can go and flip a house for, you know, and get like 20 or 30% ROI, but you're usually doing that on like tens of thousands of dollars, not to the tune of like millions of dollars. On top of that, this is the passive return. So you're not even doing the work. You're relying on the operating team to be able to do that and still hit these returns. And that's going to be overall, right? Cash on cash, we're looking at 7%. There's a preferred return involved on this one, meaning that after we pay, you know, we collect the rents, we pay our expenses to run the place, we pay the bank because they're first in line, then the investors get 7% on the cash that they put in. So that is going to be able to give you that 7% cash on cash return. So, and we pay those quarterly, every 3 months. We call it mailbox money, right? I just got one last Thursday from one of my properties in St. Louis. That money was sitting in a checking account, getting a savings account, excuse me. It was getting me 0.01% from Bank of America as a preferred customer, right? Because I had like high balances in there, and it just didn't make sense. I'm getting probably 10 years worth of interest from one of these payments alone. Typically on these properties, we try to hold it for 5 to 7 years, sometimes even 10, or sometimes for a lifetime if you want lifetime cash flow in these deals, and we'll refi in the 3rd year. But in this case, we're actually going to sell because the market is, it looks like it's just going to keep climbing higher and higher and higher. And, you know, buy low, sell high. We're going to get in there force the appreciation through improving these properties. We're putting in about close to $750,000 in renovations, doing the things like the roofs, the interiors, new paints, redoing the resurfacing the floors in the parking lot, just making the thing really brand new, shoot the value up by like $4 or $5 million over time, and then just capture all of that growth instead of doing a refi, which is a traditionally what you would do on some of these larger deals. 7% preferred return and a $50K minimum investment is what this one calls for, which is also awesome considering it's a 506B. And like Sal had mentioned, if you guys heard earlier, there was another deal where the minimums were $100,000. A lot of times these large multi-million-dollar properties have really high barriers to entry. So getting in at 50K as the floor is very beneficial. Unit breakdown. Right now we have 25 one beds, one baths at 750 square feet, which is huge for a one bedroom. I don't know if you guys remember what it's like, or if you are living in an apartment unit, and a 2-1 at 1,000 square feet. Right now they're both renting in the 700s, but the market is actually demanding at least 925 for a one bed, one bath, and a 2-bed, one bath, about $1,000, which is cheap compared to Miami for sure. And John, do those numbers sound like they're in line with what the market's getting? Thumbs up, yeah? Yeah, see, John is a local property manager in here in the state of Florida, guys. So he knows these numbers inside and out, and he took a look at this stuff. And, the fact that he actually does this for a living really gives me another sense, it's just another layer of like comfort that I have in knowing that this is a really solid deal. Oh, really quick too. If you're ever looking at an investment opportunity from somebody else, one rule of thumb that I always have is making sure that the ratio of one beds to two beds is less than 33%, right? I always want at least twice as many two beds as I have one beds. And the reason being is the number one expense in multifamily operations is turnover, meaning when you rent it to somebody for a year and then they have to move out, and then after that year, they don't renew. That cost is going to eat up probably about 25% of your annual income just from turning that around. So if you rented it, and luckily if they paid for the whole entire 12 months, once you put $2,000-$3,000, I mean, if you're, that's going to be 3 to 4 months worth of rent that you collected just to get a new tenant in there, not to counter in, labor costs for getting a new tenant and advertising fees and everything like that. So usually 2 bedrooms have a lot more longevity. People stay in there maybe 2, 3, 4 years before they move out. And so having more 2 beds than 1 beds is really key in making sure you have a really solid investment there. These are the layouts, nothing very outrageous. It's basically the same floor plan, except that in the 2 bedroom, you have one at the end of the hallway. Kitchen's very similar, slightly bigger on the 2 bed. So a lot of the amenities that we have over here right now is, there's carpet in the living room, mini blinds, resurfaced countertops, tiled bath surrounds, spacious interiors. And when we update them, we're going to have the shaker style painted cabinet fronts. Cabinet hardware is going to be some sort of brushed nickel, something more modern, just to give the people, a sense of, hey, they really did do some really nice work in this unit. This is why it costs more than it used to cost before. We don't just arbitrarily raise the rents after we buy these things, right? That's a very terrible way of running your business and ensuring that you're probably going to have a higher vacancy amount. You got to be able to add value to this property. And we're putting in, like I said, $750,000 to turn these units around and give the tenants a really nice sense that they're living in a high quality environment, because this was built in the 70s. It's due for a refresh. And by doing that, that's how we're able to capture that missing market rent of $200 plus. And this is just a picture of what things look like in some of the upgraded units. A little bit nice, worth $1,000. Some of the things that we're going to work on: common area, the swimming pool, freshly painted exteriors, new palm trees. John had mentioned that we should probably trim some of those back, which I'm taking to my guys. Masonry construction, the stucco finish, very common in the state of Florida. Parking lot is going to be painted, mail center, and we have on-site laundry. On-site laundry is very important because it's another revenue stream that we're going to be adding in order to boost that NOI. Remember, every single dollar that we increase to the NOI is like $17 to $20 increase in value. So those quarters definitely do add up. And that's just another picture from the exterior. Somebody either waxed the hell out of that Mustang or they photoshopped this picture. So I'm gonna go with Photoshop probably. Another view from the inside, looking at the pool. And as you can see, right, there's just, you know, deferred maintenance. It's exactly, you know, so they just need to take a pressure cleaner over here, repaint these pillars and make it look nicer. It's very easy. I love when I see these properties and there's just very obvious ways. You can change out these light fixtures. It's like maybe 15 bucks to buy something that's a little bit more modern and clear and not dingy, and just, you know, just have this look a little bit more, not quite luxurious. You're not going to bump this up to an A-class property, but you know, you can make it look a lot nicer, resurfacing the pool, all those things. A little bit of landscaping done. There's just random hoses laying around. You know, it's just lazy management is what I like to call these types of things. These cables being strewn about. So our strategy for and the projected investor returns are going to be listed here. We use professional third-party management to improve the inefficiencies. The property management company we're using is called Resoprop. This is the same property management company that's managing my 166 unit in Bradenton, and I'm on weekly calls with them every single Tuesday, and they're on top of everything. I think it's Resoprop is what they're called. There's so many property management companies out there. True Patriot, though, that's the one that you want to go to in the state of Florida. All right, a little shout out for John. And we're going to complete our renovations and increase property demand. And like I said, we're already at 90% occupancy and in the current state that this thing is in. Once we start making it pop and look really attractive and people walk in, they're absolutely going to just really shoot up the leasing increases and increasing the NOI, bringing the rents to the market level, and capitalizing other untapped other income. So other income like the laundry income that I mentioned before, and also RUBS, which I'll talk about in a little bit. So these are basically our line items by our contractors. It told us how much that it's going to cost to be able to do these things. Roof replacement repair is going to be $25,000, which is actually not that bad considering how many roofs that we need to get done. Breaker box replacement in 82 of the units, all of them. So the laundry room, the clubhouse, and all 80 units, we're changing all of those out. So every time a tenant moves out, these are one of the things that's going to get fixed. The HVAC replacement, 31 of them, again, they were looking a little dingy. And updates at turnover, as you can see, is the biggest cost, right? We're putting all the money into the interiors, making sure that we can capture that full $200 of missing market rent. So the financing details, really important on this one. We're actually rolling the CapEx budget, which is the capital expenditures for fixing the property. We're rolling that into the loan. So they're going to finance 100% of that and 75% of the actual purchase price amount. So the bank is going to get this to us. We were at 4.6 originally when we made this, but it's actually lower now, which is higher on our projections, right? 36 months of interest only, which is incredibly important. In multifamily, when you are running on razor thin margins in a really compressed cap rate environment like we are right now, I know it sounds really technical. All I'm really saying is when the price is really high and the rents aren't increasing fast enough to keep up with it, it's really important to only have to pay the interest on this property, right? Because once you start paying those principal payments on, 4% plus the principal payment on the $7 million loan plus the CapEx, it adds up and it really eats away at the returns. So we have interest only for 36 months, 3 years long, and then we're going to sell. Right? So we don't have to worry about refinancing and keeping 25% in the deal and trying to get a new loan at the new appraised amount. So it's a lot of versatility here. One of the shorter plays, which is great because you get your returns back to you, and you can redeploy it however you want into another multifamily deal, which is what I highly recommend, or whatever you want to do at that point, because you've made like 50% on your money in 3 years. It took my TSP probably about 12 years to double. So maybe 6 years to go to 50%. This is a sample of the underwriting. Now this is The underwriting model that they use, Michael Blanc, same one that I like to use, just goes ahead and shows you that we're estimating the rents to increase 3% per year. I don't know if you guys have watched the news or gone to the grocery store or the gas station. Inflation is much higher than 3%, right? I had to redo my grocery budget personally because Costco wasn't doing me any justice anymore on grocery prices. But we're only, and this is what I'm talking about with being a conservative in estimating what your returns are going to be, because we're only projecting 3% rent growth. Florida, again, is like one of the hottest markets. In my Bradenton deal, we had lease trade outs from 1,000 up to 500 without doing anything to those units. And I know that Jacksonville is not going to be as hot as like a coastal city like that, but it just goes to show you that 3% is very, very conservative on those estimations for what we can get in the rents. And so in doing that, you'll see in year 2, one of the biggest things that stood out to me is taking the other income from 100,000 to 145,000. That's a 45% increase because, like I talked about before, we're going to be implementing what's called RUBS, which is Ratio Utility Bill Back System. And basically, we're paying for the water that these tenants are using. We're going to be able to bill that back to them so that it's ownership on them based on the unit size and number of tenants in there. And that's going to further increase how much we are collecting in NOI. So the RUB system alone, again, this is the rent amount, $3.8 million, $45,000 in a year divided by a 5 cap is an additional $1 million that we get just by taking, like it's already sub-metered out, right? So the owner is just not doing it. I don't know why. I've seen that a lot, but I don't know why they don't do it. But the guy is missing out on $1 million valuation of his property by not implementing RUBS. So it's just small things like that. Another rule of thumb for underwriting, when your expense ratio should be about 50% of what your effective gross income is going to be. So right over here, year 1, we're at 54, almost 55%. Year 2, things stabilize with RUBS to help bring it down a little bit more. And we're like 48, 47. So that's not overly aggressive, in my opinion. So our returns, right? So on a $50,000 minimum investment, you're looking to make about 53.88 average return of 17.96% overall, and average cash on cash at 7% because of that awesome preferred return that we have baked into the deal. And yeah, so average and the IRR is going to be about 14.63%. And that's internal rate of return versus average annual return. So this is the number taken as a whole, just divided by 3 is how it comes to 17.96. Sources and uses, again, we talked about where the money is going to be coming from. We're raising $2.9 million on this deal. I'm sorry, I just saw there's a couple of questions here. Are all interest only for PP only and deferred basis upon draws, or interest only on purchase price in construction? Interest only is going to be for all of it, Stephanie, because we are doing what's called a bridge loan that is loan to cost. So they're going to factor all that in there. So that loan balance is going to be on the purchase price and the CapEx budget. And closing costs we pay up front. Operating reserves, that's money that we have to raise but not use necessarily. This is just in case money, right? For CYA. And then there's an acquisition fee of 3% of the purchase price for everybody who's running this deal. That's how they get paid. Management services, what we do for you, due diligence, right? We walked the property. John and Sonia did it out of the kindness of their heart and probably more to secure their investment since it's their first large multifamily investment. They walked the property, they saw it, and it's like there's a lot of value add potential there. We do monthly updates, including like the property improvements, financial statements, which I'll be having a hand in as well, since I'm a senior financial analyst. And we do monthly site visits, as needed. Up front, we probably do it more often. I'll probably be going out there myself at one of these points, especially since I'm looking in that market to purchase other large multifamily with Disrupt. And as far as management goes, they're going to have oversight of the third party property management, right? So the property manager's res prop is going to be there to manage the deal, And what we do is manage the manager, right? We got to make sure that they're on top of everything, which from what I've seen, they're very, very solid. So right now I'll open it up, questions and answers. I know some people typed in the chat. Sorry, I missed it. I was focused over here on that. You can unmute yourself, ask me anything that you guys want to know. Not everybody at once.
Hey, Russell. Go ahead.
Sorry. Could you go over, like, okay, for people that do invest to 50K, like what the cash flow would look like based off of the projections that you put up? Like,
Absolutely.
could you explain it a little bit more?
Yeah, for sure. So right here actually is a very good, I guess it's not that good because, oh yeah, right there. So up front, as you can tell, in year one, because we are in the beginning, we have to do a lot of work of stabilization, right? So the distributions don't happen typically for about 6 months is what I've seen. Sometimes 9 months if it's a very heavy lift, which I don't anticipate for this type of property. But you can see in year one, you're going to have 1.7% investment ownership into the deal. You remember cash flow for that first year is going to be $900. Not very attractive, but it's like 1.8%. And then in year two, with that 7% preferred return kicking in, is going to be more about because we're going to have increased rents at that point, and the spread that's going to be distributable is going to increase over time. So as we're increasing those rents and decreasing our expenses, we're looking at about 3,220 annually in quarterly distributions. So 32 divided by 8 is probably going to be 800 and some change. 32 divided by 4 for the quarters, 4 quarters. So every 3 months, you'll probably get a check of like $800 or so in your mailbox, which is going to represent a 6.44 cash on cash return. And then year 3, once we've completed the full renovation cycle and we've maxed out the value of that property, that's when everything averages out to that 53%. Because as you can see, you've got a much bigger slice of the pie at 6,300 for the cash flow, which is 12% cash on cash. And then that's averaging it out to 7. So 6 plus 3 plus 900 is going to come out to 2280 in cash flow. No, that's plus the proceeds from the sale as well. Sorry, that's 3, 6. It's going to be 10. Be about $1,100 on that. Plus, when we sell the property, the value is going to increase for your $50,000 portion by $16,000. And then obviously we return back your initial investment of $50,000 at that point. And that constitutes a 53.88 total return on your investment. Let me go ahead and add that up because it's not very readily apparent from this chart. I just look at this every single day. So you're making 900 year 1, 3220 year 2, 6380 year 3, plus you're going to get the proceeds from the sale, 1644.0. So that's $26,940 total return, and then divide that by your $50,000 investment over 3 years, 53.88%. Does that clear it up a little bit better, Yvonne?
Yes, it does. And did you say, so the 26 is that in addition to the 50,000? Are you saying that we get the initial $50,000 investment back once we sell it plus this?
Yes.
Okay.
Yeah.
Okay.
Yeah. You get a return of your principal. So you put in 50,000, you'll get back 76,940 is how it goes in.
Okay, got it.
And if you want, you can click your you can put you raise your hand on Zoom. There's a little react thing that you can do as well so that I can notice who's asking questions. I think that was Cynthia. You had a question next?
I did. To know, can we use the IRA investment?
That broke up a little bit. Can you say that again? It's something about the investments.
We use a self-directed IRA for the investment?
Yes, you can use a self-directed IRA for the investment. As a matter of fact, that's actually really awesome to use, especially if you have a Roth, because then all of your returns are tax-free. Ask your CPA. I'm not a CPA. Don't take my word for it. Disclaimer on that one, because I'm not giving tax advice as a financial analyst is not licensed to do so. But yes, you can use your self-directed IRA. I've had many investors do that on my previous deals already. So, and it's just as simple. You tell your custodian, hey, this is where I want to invest, and this is what I wanted to do. And it's really good because if you have a self-directed IRA, and if you're some sort of a business person or an investor, you cannot invest in something that you are directly responsible for from the management side. And so you can only invest passively as a third party with an SD IRA. So that I feel comfortable saying. So it's a very, very viable option to go and get really strong returns that are protected by real estate and yeah, not subject to this crazy market volatility like you'll start seeing in the single family homes when the foreclosures really start coming out.
Awesome. Thank you.
Very welcome. Sanchez, you had a question? You were saying something, or maybe you were just on the phone.
No, I didn't have any questions.
Awesome.
I was talking to myself.
Gotcha. Yeah.
Mhm.
All right, looking here. I'm gonna read the chats real quick. But if that is well, if there's no other questions, I mean, it's very straightforward. Andrew Curtis, raise your hand. What you got, my man?
Yes, sir. How goes it? Just wondering if things change with the market. I think the 3-year exit, everyone getting their money back is great. But if things change with the market, what are the I guess the alternative scenarios that could potentially play out?
In my opinion, if the market was able to boost even more and stay crazy the way that it's been going, it would make sense for me to do a refinance instead of a sale, to be able to keep the property and have all of the investors still maintain their ownership percentage, albeit you'll be getting a lower return, but you're going to have a lot of you have all of your capital get back to you, and you're still getting cash flow from this deal for as long as we keep the property. I think that would probably be the best move. And that's like a better case scenario. Worst case scenario, I'm pretty much already looking at worst case scenario when I look at this. I can't foresee something making rents go down as long as I've been alive. Even during the Great Recession, rents did not go down. Vacancy went up because the residential market crashed so low, it just made sense to buy a house at that time. So people who were renting were like, well, I'm not paying rent when it's, almost as much as being able to buy a house. And that's the thing that's really going to keep things going. So rents won't go down. And I think more people are actually leaning towards rentals than they are home purchases, because, truth be told, buying a house is actually not that big of a boost to your overall wealth. It really ties up a lot of money and gives you a lot of expenses. Was that a good answer for you, Andrew?
Yes, it does. Thank you. Actually, that was way more in depth than what I was thinking. I need to read some more books. You are the man and the legend.
Thanks, Andrew. Hey, John.
Where am I? How you doing? Yeah, Sonia and I, who provides the contracts? What documentation do we need to sign? Where does the wire transfer go? And I take it if I double up on the 50, I just double all these numbers, correct?
Absolutely. It's very straightforward. Everything's percent based. So 53.88% is going to be on 50,000 or 100,000, or like one of my investors putting in 300,000. your ownership percentage is going to increase, right? Because again, if you call it $3 million of what we're raising, if you put in 300,000, you're going to have 10% of the limited partnership, right? The limited partnership is worth 70% of the overall deal. And I know the math can get a little bit funny when you start talking about this, but we're operating on a 70-30 split. 70% goes to the investors, 30% goes to the managers, which is why we have that fee up front, because we have such a little bit. I mean, if you guys think, you gotta understand this 900, 3,200, and 6,300 represents a $50,000 portion of a 70% ownership stake. For example, so on somebody on the management side who had an equal stake worth 1.7%, they would be getting a third, less than a third. Oh no, about half. Right, 30 divided by 70, so a little bit less than half than all this. So they'd be getting like 400 and 1,500, and then maybe 3,000 overall. So that's that, and they're the ones doing the physical work. You guys are getting double that, being passive and everything like that. And to be able to sign up, get all the paperwork done, and again, because there are a 506B syndication is a filing, it's a petition to the SEC for an exemption to registering as a security, right? So there is a lot of paperwork involved, and those documents get signed through an investor portal, which I will shoot you that link that goes to the portal that has all the information, including the wiring instructions and the designation. If you can say, hey, yes, I'm an accredited investor, or hey, no, I am not an accredited investor. And there is something that's called a PPM, which is a private placement memorandum. That is a required document for all securities, where the SEC wants to try to scare the investor as much as possible. Say, hey, even though you're investing in the real estate, all of these bad things could happen and you could lose your entire investment, right? Because there's no such thing as saying, oh, I'm going to guarantee that this thing is going to do 53.88%. I don't know what the future is going to hold. I just understand that if commercial multifamily is failing, then everything else is on fire and it's like dead. Like there's some catastrophic event that's happening to cause this to fail. We might be bartering instead of using dollars and using like, toilet paper rolls and rolls of bread or something like that at that point. But we're going to make sure we're getting 53.88% of those rolls and bread and all that other stuff too. Right. Going to make the equivalent somehow, some way. But yeah,
Okay.
Long story short, there's an investor portal link. As a matter of fact,
Are we going to have to provide proof of our assets?
nope.
Okay.
They're gonna ask you. Actually, on a 506B, I don't know. I've invested in 506Cs where I had to do that and sign my net worth over, but I don't know.
What do you mean sign your net worth over?
I signed on the debt for a deal.
Did you?
Yes, because I put my net worth on the line. So the management team has to have a net worth greater than or equal to the amount that we are buying this property for. So all in, we're about $11 million. The sponsorship team has to have a net worth of $1 million. And I think we have one guy who's putting his net worth up for the whole entire deal. So that's another added layer of security. If this very high net worth individual, our key principal, is putting his finances on the line to be able to run this deal, I feel a little bit better about putting $50,000 or $100,000 into a deal.
Right. All right. Let's say, we go in on this deal and you come up with another deal in Gainesville, like you say you're looking at, right?
Mm-hmm.
And say I'm out of cash. However, I have plenty of equity and assets. Would I be able to put some of my assets on the line without, selling the asset to get the money to go into this deal? Is that what you're saying?
So from a management standpoint, that's a little bit more technical, and technically, yes, you could sign over as a KP, the same way this individual is doing on this deal, right? So you wouldn't be a passive investor in that case. You'd be a manager, and you would be subject to any like ups and downs and bad things that happen, right? Let's just say there's a lawsuit or something. You'll be liable in that instance. You're not protected as a passive investor from those types of things. The management team is taking all of that risk in doing that.
Okay, but then say like, say it was this deal, right? And I put in, I wanted to put in $1 million, right? I wanted to put some of my assets on the line. So at year 3, would they release my assets at that point?
Yeah, most
You see what
likely,
I'm saying?
yes.
Because if I'm getting my 50,000 back on year 3, would they
Mhm.
release my assets?
So we're talking about two different things. As a
Okay.
$50,000 investor, you're a limited partner. You're LP. You're insulated. You're protected. It's all passive. There's nothing that you're on the hook for, right? You're putting your $50,000 up. You're hoping it's going to do well, hit these projected returns. Ideally, go better, because I like to underpromise and overdeliver. Make sure that these things perform a lot better than what the market is showing me it's going to do. And by signing your assets over, you're talking about being in a management role on the GP side. And those are completely separate.
Gotcha.
You can be an LP and a GP on a deal. I've done that too. And 4 of my deals, I'm invested into it and I'm on the management side.
Okay, it sounds like something that Sonia and I just need to get our feet wet in little deals like this, and then you and I will revisit that conversation later down the line.
Absolutely. Yeah, for
Okay.
sure. And I'll keep you in mind for that too, if you want to.
Just so you know, we have the abilities.
Awesome. I love the questions, guys. Come on. Anything else? Test my knowledge. Make yourself feel comfortable with alternative investments, because a lot of people put their money into 401ks or IRAs, and it blows my mind that these things average 8, maybe 10% on a really good year. And
I got a question.
oh yeah, sure, Naeem.
I got a question, Russell. So if I was to put up $1 million, what would that percentage be like? I'm coming in on behalf of Stephanie.
Yeah, so $1 million on a $3 million raise would be 33% of 70%, which would be about 21% overall, I think, right? Divided by, oh, sorry, $1 million. Can you guys see my calculator on my screen? Okay, cool. 1 million divided by $3 million, 33% times 0.7, 23% ownership overall. So if you're putting in $1 million and we're projected to make a 53.88% return times 1.5388, at the end of 3 years, you will have $1.5 million.
Okay.
I think I have one other $1 million investor on here too, but I don't see his name. But I'm recording this, so it'll go back to him. And yes, it's like I was saying before. Did I answer your question, Naeem? Making sure, Naeem and Stephanie.
Yeah, 100%.
Awesome.
Yep.
Yeah. Like I was telling a lot of the other people who are very new to this and the concept of investing into a 506B syndication or something. We call these alternative investments. If you think about what we're all conditioned to do from the perspective of, you work hard, you're 9 to 5, or if you have your own small business, something like that, you put money into an IRA or a 401k, a 403B, or some sort of government sponsored retirement program. They tie that money up until you're 59 and a half. If you want to touch that money and pull it out, they'll give you a penalty of like 10% and then tax you on top of that. Right? With multifamily, we actually have something that's called the cost segregation that we can do and you can do this on residential as well, but the scale on multifamily is so much more huge. You can enjoy what's called depreciation. So in residential properties, 1 unit to 4 units, you have 27 and a half years of a straight line depreciation, right? On commercial properties, it is 39 years. And so what that looks like is it's a tax write-off. It's a phantom loss by the IRS code, right? Again, not a CPA. Ask your accountant about that. But if we're buying a $9 million property and you do straight line depreciation for 39 years, every single year, the property as a whole, right, gets a $230,000 tax write-off. But when we do what's called a cost segregation study, you guys saw the level of CapEx that we're going to put into this thing. We accelerate that depreciation and take 90% of it in year 1. So if you take $9 million in the purchase price and you times that by 0.9, 90%, That's $8.1 million in write-offs that we take. And of course, it's split between everybody because 70% for the investors, 30% for the general partners. And that will offset however much you're making on these things. So not only are you making much higher returns than you would get from a traditional retirement account, you're also not having to pay tax on it, right? When you pull money out of your stock market account or your brokerage account or your retirement account or anything like that, as soon as that happens, taxes hit right off the bat at your regular income level, right? And if you want to use it before you're 59 and a half, then there's a 10% penalty on top of that. And if you just want to sit there and let it grow, they're going to force you to take it out once you hit 72 and a half, or you're going to get a 50% penalty for not taking the money out and then having them charge you tax on it. So your choice.
So how can you, so when you say leveraging, to piggyback off of John, so as far as leveraging assets, when you say assets, we talking about our personal real estate, like our residential properties and things of that nature?
Yes. Yeah. You're basically everything that contributes to your net worth. You can sign that over to sign on the debt for one, or well, yeah, actually you'd have to do it to sign up for the debt. That's really the only reason why you do it. And then you would get a piece of the ownership of the property on the management side for doing so. That's like a little bit more advanced than what I was, explaining with this proposal here. And you would have to probably have a high enough net worth on your own to do it. You wouldn't be a part. Like, this is a $9 million deal. If you had at least a $9 million net worth, cool. You can go ahead and do that, and you'll probably get 15% of the management, 10 to 15%, just for signing your net worth to this deal and getting this loan done for the operation.
Gotcha.
Right? But you'd probably want to do that and be very experienced, and probably choose to want to be very hands-on in that case, because a lot of times, though, honestly, we do non-recourse loans. So even if stuff hits the fan, the bank will just take back the property. All right, no recourse. We're done. It's okay. We'll try to sell it and get back what we put into it, something like that. That's like worst case scenario. I haven't heard of anybody going through that. Although I'm sure it has happened. I just don't deal with people like that. And once that does happen to somebody, they're basically like kind of frozen out of the industry, because nobody wants to touch them. Nobody wants to be within, 5 feet of those guys. John, you have another question?
We issued 1099s.
No, you were actually issued what's called the K-1 statement. And the K-1 is going to be your SEC filing form for your taxes, explaining what you were paid, whether it was passive, active income, if you're on the management side, how much depreciation you get to apply for. And if you're a real estate professional, like my man John over here, then you can actually enjoy 100% of that bonus depreciation. If you're not a real estate professional, you're capped at $25,000 per year. So, and it rolls forward, and it only offsets your passive earnings, right? You can't use, so if you say an example right here, you have $25,000 per year you can write off. Again, not a CPA, just my understanding of how this works. You can have $25,000 of losses in year one. You're getting paid $900 and you have a loss of $25,000. You can only write off that $900. You can't affect your active income if you have other sources of income, right, unless you're a real estate professional. So Stephanie, boom, you're set. You can start racking up these depreciation things because you're a general contractor, right? So it actually has a very big plus for you being invested into multifamily and banking on some depreciation. And it rolls over year to year, that you can continue to keep using that if you don't use it all in year one.
Okay.
Nice.
Cynthia?
Yes. Is there a deadline to sign up for this investment?
Absolutely. This is on a first come, first served basis. And this deal is going to be closing on February 20th, right? So,
Okay.
yes. So it's on a first come, first served basis. And the hard part is telling people, hey, I'm sorry, there's no room for you on this investment. John, Sonia, you guys know firsthand what that's like with the Cheval deal that we closed in December. That was an amazing, crazy buy in Houston, 387 units, Class A. I went to it, I walked it. I wanted to live there because it was amazing looking. And I did the deal presentation for John and Sonia. I think I did it just for you guys, just one-on-one, actually. And it wasn't only you guys, it was a couple other people that I did it for too. And none of them got in there because we were raising $25 million and it filled up within a week. That was with my main squad, Disrupt Equity, which I'm director of acquisitions for. This one is a smaller deal with a different team that doesn't have the infrastructure and marketing prowess of a large private equity firm like Disrupt Equity. These guys they're smaller operators, and that's how a lot of these deals get done. If there isn't some, like there could be some people running around with like a net worth of $10 million and they could take it down themselves. If they're in real estate, they've been doing it for decades, and they can be a one-man shop to do all this stuff. I actually only know 2 people who do that, and they're married to each other. So it's not a very common thing to have happen. You usually see the syndications on this size deal. This is too small for an institution to want to go and buy, so they're not competing with these guys, and it's too big for an everyday retail investor like a lot of us who are into, residential multifamily or residential properties. We have duplexes, triplexes, quadplexes. We wouldn't touch an 80 unit, right? So that 80 unit, 50 to 80 is like a very safe place to go and find a really good deal if you're interested in putting together a team and learning how to do this and all that stuff.
Hey Russell, how are you?
Good, Stephanie, how are you?
I'm awesome. So one question that I can think of at the top of my head. I know for this deal you have someone, I don't know the term, but you have someone on the GP side who is leveraging their net worth and so forth. So even for a future deal, like if someone's worth like, let's say 5 million, then another person's worth 5 million, let's say the deal is like, 10 to 11 million. Can 2 people wind up splitting that, or is it like one person has to put up all of their net worth for a deal?
No, that was me. That was me in my first syndication, man. It was me and a bunch of guys who didn't have the net worth. I might have been the biggest one of them, but we didn't have, between 4 of us, enough net worth to take down that deal individually. So we had to combine, and we all signed our net worth to that deal.
Got you.
So yeah, if I take that back, John, maybe you could possibly, be a part of it, and then you get a prorated amount based on, like, if it's a 15 million and you have like a 5 million, you can get 30%, 33% of that 15%, and get 5% of the GP in that case, which would be 1.5% overall ownership, or 1.5. Yeah, 30% times 5%.
So in a case like this, since you already have that one person who, let's say, is making 15% of the, let's say, 30% on the GP side. So since they're covering the overall deal, I guess, would you take on another, GP in that position that would put up their, assets basically, or is that person like locked in? Like,
they're locked in. That's what he does. He signs his net worth to deals that he likes. And that's how he does it, right? And that's the name of the game, honestly. I would love to be in the position where I'm only signing my net worth over to awesome deals with great operators, and also just deploying capital at really high levels, right? Just like, oh yeah, I want to put $1 million in this deal, put $1 million in that deal, and then just control where my money's going and have the passive residual income paying out, 7% preferred returns. And then, 17% average annual return once we go and sell or refi the property, right?
Okay.
And that's where you really, really want to be. That's when mama, I made it, right? But in the meantime, I love the compounding over here, because is anybody familiar with the rule of 72? All right, I'll go ahead and explain it if you don't know. The rule of 72 is basically a quick calculation that you can do to figure out how long it's going to take for your money to double. So you take 72 divided by your interest rate. So let's just say the average return in the stock market is 8%. You do 72 divided by 8. It's going to take 9 years for your money to double. You put in $100,000, you'll have 200,000 in 9 years if you hit 8% every year, right? So in this case, we're looking at 72 divided by 17.96. Divided by 17.96. it's only going to take 4 years for your money to double, right? So every 4 years, your money is doubling. And you got to keep in mind, if you think about financial planning from however old you are right now to however old you want to be when you retire, there's not a lot of time to be able to double your fortune over and over and over. And I don't know any other investment that's as reliable and as solid and risk averse as real estate is. Yeah, I know I've got friends who are making thousands of % returns in crypto and NFTs and also the garbage that's going on, but it's hot for now, right? People are talking about Shiba Inu coin and Dogecoin and all this stuff. And they're telling me buy, 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 buy. I was like, nah, man, I'm good. I'm gonna leave it alone. I saw them come in, they're buying at like 40, 50 cent a coin, and then it dropped down. It's like worth 10 cents now. And so they literally lost 80% of what they put into it. Right? That's a hard game to play. Yeah, it's basically, in my opinion, it's gambling. I don't like gambling. I'm very conservative, finance wise. I want to be able to get the most out of my investment anytime that I can, and I want to have the least amount of risk associated with it. Short of starting your own business or flipping residential houses and doing a lot of hard labor work, I don't know how else you're going to get like 18, 20% on your money and not have to do the work for it. Personally, that's just what I've seen. If you guys do know, let me know, man. I'll sit on a webinar and I'll learn. I'll pay you to teach me.
So my other question is, since we're on page 27 right now,
Sure.
on your screen. So with the 7%, the I guess that's the average cash on cash return. Is that everyone splitting that? Because
Yes.
okay, so everyone's splitting that 7%. So that's how you get to like the 1.7% of the overall, like right where it says the percent of the overall membership ownership.
That's this individual's amount right here.
Okay, so if someone's putting $50,000 in, they have 1.7% ownership, correct?
Right. So if
Okay,
so the $900 means that the cash flow for this year was the distributable cash flow for the general partners, or for the limited partners, was $52,941. Overall, divided by 70%, it was $75,000 net cash after the mortgage was paid. Right? And I don't know what the mortgage is right off the top of my head, but it's interest only. And I can pull up, let me see. I think it's because I'm sharing. Okay, here we go. Here's my crazy spreadsheet that I use to run these numbers, right? I look at all of this stuff, different scenarios. I look at the rents. We break out the expenses line item by line item. Taxes are the biggest monster in Florida, Texas, all the red states. That's the one of the drawbacks, right? Is that, you get a lot of landlord privileges, but they're going to get their taxes one way or the other. The other benefit is, hey, when it comes to doing real estate investments, you get tax benefits, right? But if I go to the profit and loss statement, you see we're collecting the money. Total net income, $934,000. Total expenses is going to be $489,000. We're left over with $45,000. We got to pay the bank the interest only portion of $314,000, and the distribution that we have goes to the payouts. A nominal amount goes to the manager, $18,000 annually. The members' preferred return get $190,000 that's due to them, meaning that you're racking up a deficiency, meaning there's money owed to you at a later date to be recaptured basically once we sell, right? And then, so the 7% that we can pay out is going to be $112,000, and there's no access to everybody else. You guys have it all, and there's nothing that goes to the manager, right? And that happens over and over and over until we sell. And then once we sell, then the net proceeds get split up 70-30. So of that $1 million that's made on the sale, 720,000 goes to the investors, 300,000 goes to the managers, and that's divvied up on each side.
Okay.
Depending on how that works.
Okay, can you just explain, so I understood that, can you just explain the deficiency part? Because that's about 78,000 that is
Yes.
being held.
Yep.
And does that have to do with when you sell the property, or does it have to do with like, if anything comes up that you're securing that?
Nope, that's not a securing, that's a debt to the investors, right? So
Mhm.
basically, we know that the amount that we owe to the investors is $190,000. But after all of our expenses and after paying the bank, right, we got to pay the bank to make sure that we can keep the property. We only have 131,000, meaning that there's $78,000 that we owe to the investors. So that gets added up. So the next time we go in the next year, right, we have 238,000 because rents are going up and our income's increasing. We're executing the business plan, increasing the spread that we have available. So the asset manager gets their fee to make sure that they can keep, they can live and do what they got to do. The preferred returns that are due on the deal is 268,000 because that's including the deficiency from before, right? So now we need to pay out 268,000. We only have 238. So we're still missing $51,000. 217,000 is what we have available to pay. Nothing gets split up 70-30. There's nothing left over. All 217 is going to the investors. And then in year 3, that's when we're going to go ahead and make up that difference. Even though operationally we only have enough to pay all of it except for $3,000. Once we sell, we have that $1 million a bonus payout. 3,000 is going to get paid to the investors first, and then the proceeds are going to get split 70-30. I hope I explained that well.
Yes, I understand.
Boom.
Thank you.
Very welcome. So I'm going to go ahead and stop the recording right now because I know somebody's going to watch this, and then I don't want them to go and get bored. Please tell me I was recording. Okay, good. Oh no, that's just share. I'm going to stop sharing for now, and then I'll stop my recording.